If you make a down payment of less than 20% of the purchase price of the property when you buy a home, lenders require the borrower to purchase private mortgage insurance, which is also known as PMI. PMI is insurance against loss from mortgage default provided to the lender by a private insurance company. So basically, PMI protects the lender if you do not pay back your mortgage. PMI typically requires that the borrower pay an ongoing annual fee on a monthly basis. PMI rates vary depending upon several factors, including loan-to-value ratio, which is the ratio of your mortgage amount to the value of the property you are buying. The higher the loan-to-value ratio, the higher the PMI fee. Credit score. With the higher your credit score, the lower the PMI fee. Mortgage term. The shorter the mortgage term, the lower the PMI fee. Mortgage amount. If the loan amount is greater than $417,000, the PMI fee is higher than if the loan amount is less than $417,000. And finally, mortgage type. Fixed rate mortgages have lower PMI fees than other mortgages such as adjustable rate mortgages. For example, if you're buying a property for $300,000 and make a down payment of 5% or $15,000 and obtain a 30-year mortgage for $285,000 for the remainder of the purchase price, your loan-to-value ratio equals $285,000 divided by $300,000 or 95%. As I mentioned, PMI rates vary but can be approximately 0.62% of the mortgage amount for a 30-year fixed rate loan with a loan-to-value ratio of 95%. So for the $285,000 mortgage in our example, the borrower would be required to pay approximately $1,765 a year or $147 a month in PMI fees. The borrower only has to pay PMI as long as the loan-to-value ratio is greater than 80%. The loan-to-value ratio decreases as the borrower pays down the mortgage balance over time or if the property value increases. And the borrower can request to have the PMI fee removed if they believe the loan-to-value ratio is below 80%. Requesting the removal of PMI can be a time-consuming process, and the borrower may be required to pay for an appraisal to demonstrate that the property value has increased. But removing PMI can save the borrower a significant amount of money in the long run. It's important to point out that some lenders may charge a higher interest rate instead of charging PMI. So the lender may offer you an interest rate of 4% if you make a down payment of 20% and an interest rate of 4.5% if you make a down payment of 10%. In many cases, paying a higher interest rate can cost the borrower more than paying PMI fees because the borrower pays the higher interest rate over the life of the mortgage unless they are able to refinance. So if you decide to make a down payment of less than 20% and the lender does not require that you pay PMI separately, be sure to ask the lender if PMI is included in the interest rate. And if the answer is yes, which it should be, ask what the interest rate would be if you paid PMI separately. If you pay for PMI separately, the interest rate should be lower and you will be able to have the PMI removed when your loan-to-value ratio drops below 80% in the future. This could save you a significant amount of interest expense over the life of your mortgage. We encourage you to review related freeandclear.com videos such as what size mortgage can I afford and what size down payment do I need to buy a house, and check out the First-Time Homebuyer's Basics Guide on freeandclear.com. Thank you for reviewing what is private mortgage insurance and when do I need to pay it with freeandclear.com. freeandclear.com.